Each year, around 70% to 90% of individual investors in the United States lose money in the stock market. In fact, just a couple of years ago, in 2022, the annual percentage declines for all three major indexes were the largest since the 2008 financial crisis. According to data from the Federal Reserve, the bottom 50% of American investors lost about $70 billion in stock wealth. The top 1% lost over $5 trillion in stock market wealth. Even worse, the top 10% of Americans lost over $8 trillion in stock market in 2022, marking a 22% decline in their stock wealth. This data is alarming. Why do so many investors suffer losses in the stock market? It's because they don't have the right investment strategy. A well-thought-out strategy is what separates an unsuccessful investor from a successful one, like Warren Buffett. With the right investment strategy, a professional investor can make a profit even during market downturns. For example, in March 2000, when the dot-com bubble burst, the Nasdaq lost nearly 78% of its value over the next 2 years. Many overvalued dot-com companies went bankrupt, and trillions of dollars in market value evaporated. It was one of the major stock market crashes in history. Yet, Warren Buffett made a profit during the dot-com bubble burst because he avoided investing in unproven technology stocks. Why? Because he had a crash-proof, right investment strategy. In this video, I have decoded the 6 golden rules of Warren Buffett's investment strategy. These rules are essential, and you can't afford to ignore them if you want to be a successful investor. These 6 golden rules are so significant that I can guarantee this. If you miss any of these rules or skip this video, you will likely experience losses in your stock market investments, and that's the last thing I want for you. So, watch this video carefully till the end. Are you ready? Let's get started. Rule 6. Imagine you're a 10-year-old kid and you just got $10 from your grandparents for your birthday. You're super excited and thinking about what to do with that money. Maybe you'll buy some candy, a cool toy, or maybe you'll save it to buy something bigger later. But wait, what if there's a way to make that $10 grow into even more money without losing it? That's where one of the richest and most successful investors in the world, Warren Buffett's 6th golden rule, comes in. That is, never lose money. Warren says, rule number 1, never lose money. Rule number 2, never forget rule number 1. But what does never lose money actually mean? Let's stick to your birthday example. Imagine you decide to spend $5 on candy, and then you accidentally lose the remaining $5 on your way home. Now, you've lost all your money and you can't buy anything else or save for the future. That's what Warren means when he says, never lose money. He's telling us to be super careful with how we use our money so we don't waste it or lose it. But why is losing money such a big deal? Here's a fun math story. Let's say you had $10 and you lost half of it. Now you only have $5 left. If you want to get back to $10, you don't just need to make back the $5 you lost. You actually need to double your $5 to get back to $10. That's a 100% gain. See how hard it is to recover when you lose money. So, how does Warren Buffett avoid losing money? Warren Buffett doesn't just throw his money at random things. He's like a detective searching for the best companies to invest in. Here's how he does it. First point, strong fundamentals. Warren looks for companies that are like strong houses built on solid ground. They have good earnings, a solid reputation, and smart leaders who know what they're doing. For example, companies like Apple or Coca-Cola. They've been around a long time and people trust them, as big companies are less risky than a new startup, right? Second point, competitive advantage. Buffett invests in companies that are the best at what they do, so it's hard for other companies to beat them. For example, imagine you're the best employee in your company. No one can outperform you, so you always win the incentives. Companies like Disney or Nike are like that. They're so good at what they do that it's tough for others to compete. Third point is consistent cash flow. Warren chooses businesses that make money regularly, not just sometimes. For example, if you run a lemonade stand every weekend and you always sell out, that's consistent cash flow. But if you only sell lemonade once every few months, that's not reliable. So remember Warren's first golden rule: never lose money and never forget that rule. Whether it's your birthday money, allowance, or future earnings, treat it like gold. Protect it and grow it. Rule 5. Imagine you're a shopkeeper running a cozy little store in your hometown. Every morning you open up the shop, stock the shelves, and greet your regulars. Now imagine this. You're making steady income, but you notice something strange. At the end of each month, there's barely any money left in your pocket. Where's it all going? That's where Warren Buffett's 5th rule comes in. Spend wisely. But what does it mean to spend wisely? Think about your shop. If you spend money stocking up on flashy decorations or gadgets nobody buys, you might end up struggling to pay for essentials like new inventory, rent, or utilities. Spending wisely means focusing on what's important and not wasting money on things you don't really need. For example, Warren Buffett is one of the richest people in the world, but you'd never guess it by how he lives. He still lives in the same house he bought in Omaha in 1958 for $31,500. He drives simple cars, not luxury ones. He doesn't splurge on fancy gadgets or expensive vacations. Why does he do this? Because he knows the value of every dollar. Instead of spending on things that don't matter, he invests his money in things that grow over time, like businesses and stocks. Because there is a difference between needs and wants. Let's look at your shop again. Needs are the things your business can't survive without, like inventory. Example, milk and bread. Utilities to keep the lights on. Repairs to fix a broken cash register. Wants, on the other hand, might be things like a new coffee machine when the old one still works fine. Expensive decorations that don't attract more customers. So if you spend too much on wants, you'll have less money for the needs. So prioritize your needs more than your wants. It doesn't mean Warren Buffett's approach is about being cheap or depriving yourself. Rather, it's about thinking long-term. For example, if you're considering buying a flashy new sign for your store, it costs $2,000. Instead, you decide to spend $200 repainting your old sign and put the remaining $1,800 into savings or investments. Over time, that money could grow and help you expand your business later. So, avoid lifestyle inflation. What happens when your shop starts earning more money? It's tempting to upgrade your lifestyle. Maybe you buy a bigger house. Maybe you splurge on a luxury car. But Warren Buffett teaches us to avoid lifestyle inflation. Just because you're making more doesn't mean you should spend more. Instead, focus on saving and investing that extra income. Think of someone like Sam Walton, the founder of Walmart. Even though he was a billionaire, he drove an old pickup truck and focused on running his stores efficiently. In short, track your spending. Look for areas where you're spending on things you don't need. Set your priorities. Focus on spending money on your needs to avoid unnecessary expenses. And invest in the future. Invest your savings in something that grows over time, like a retirement fund or stocks. And always remember Warren's golden words. If you buy things you do not need, soon you will have to sell things you need. Keep that in mind every time you spend a dollar. Rule 4. Imagine you've been dreaming about buying a car. Not just any car. You want something reliable, good-looking, and worth every dollar you spend. But here's the thing. There are so many cars to choose from. And some are cheap, while others are super expensive. How do you decide which car is the best deal for you? Now, Buffett's golden rule number 4 will help you figure out this problem. This rule says, stick to values. But what does stick to value mean? Imagine you're standing at a dealership. You see 2 cars. Car A is a cheap used car, but it's got high mileage, scratches, and no warranty. Car B is a slightly more expensive car, but it's known for reliability, comes with a warranty, and has great fuel efficiency. Warren Buffett would tell you to focus on value, not just price. Car A might cost less today, but if it breaks down or needs frequent repairs, it'll end up costing you more in the long run. Car B, on the other hand, might be a bit pricier up front, but it's a better investment because it'll serve you well for years without draining your wallet. So, how does this apply to investing? Warren Buffett isn't just looking for cheap stocks. He looks for strong companies that are worth more than their current market price. Let's think of a company like Coca-Cola, which Warren invested in heavily in 1988. Why? Because it was a strong brand. Coca-Cola wasn't just any soda company. It was a global brand that everyone recognized and loved. It had a consistent cash flow. People buy Coca-Cola every day, all over the world. That steady and reliable income. Buffett saw its growth potential. Even back then, Coca-Cola had the potential to grow even bigger, reaching new markets and customers. Buffett didn't just look at the price of Coca-Cola stock. He looked at the value of the company and decided it was worth investing in, even if the stock wasn't the cheapest on the market. And this requires immense patience and research. For example, if you want to buy car B, because it's a better deal, but still you will take time to compare the same model of car B from different dealerships. You will check reviews and talk to friends who own the same car. You will still wait for a good deal, like a holiday sale or end-of-year discounts, so that you can get the best deal possible. Similarly, Warren Buffett's approach isn't about rushing to make a decision. He takes his time to do research, learn everything he can about the company, wait for the right moment. He doesn't buy just because everyone else is buying. He waits for the best opportunity. As he says, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. But what makes a wonderful company in investing? When Warren Buffett talks about a wonderful company, he means a business with strong balance sheets. It doesn't have too much debt and manages its money well. Reliable earnings. It makes money consistently, not just in good times but in tough times too. Competitive advantages. It's better than most of its competitors, like Apple, which has loyal customers and innovative products. So, whether you're investing in stocks or buying a car, take your time, do your research, and always look for the best value. That's how you make smart financial decisions. So far, we have covered 3 rules. Rule 6, never lose money. Rule 5, spend wisely. Rule 4, stick to values. The remaining 3, golden rules of Warren Buffett's investment strategy, will be covered in part 2 of this video. In the meantime, you can watch Robert Kiyosaki's 8 Wealth Building Secrets.